Hello, everyone, and welcome.
Hi there.
Today, we're going to chat about something really fundamental when it comes to money. It's this idea of risk versus return.
That's right. And put really simply, it's about the chance of losing some money compared to the chance of making some money.
Exactly. We'll keep it nice and straightforward, like explaining it for the first time.
Okay, so let's start with risk. What does that actually mean in simple terms?
Good question. So risk is basically the chance, the possibility that you might lose some of the money you put in. Or, maybe you just get back less than you were hoping for. It's that uncertainty.
Right, the not knowing exactly what will happen. And return. Return is the other side of the coin. It's the profit or the gain you might make. So if you put in, say, $10 and later on you have $12.
That extra $2, that's your return.
Exactly. But it's important to remember return can also be negative.
Meaning you could end up with less than your $10.
Precisely. You could get back $8, for instance.
Okay, so how do these two things, risk and return, connect? What's the main idea?
Well, the core principle, generally speaking, is that if you want the chance to get a higher return,
To make more profit?
yes, you usually have to be willing to take on a bit more risk.
Okay, can you give us a simple example?
Sure. Think about putting your $10 into a standard bank savings account. The risk of losing that original $10 is very, very low, right? The bank is usually very safe.
Yeah, feels safe.
But because it's so safe, the return, the extra money you get back, maybe interest is typically quite small. Maybe you get back $10 and a few cents.
Okay, very low risk, very low return.
Now imagine taking that same $10 and let's say you use it to help a friend start a small new shop. Company A, perhaps?
Okay, a bit different.
Very different. There's a higher risk there. The shop might not do well. It could even close down.
And I can lose my $10, or some of it.
Yes, that's the higher risk. But if the shop does fantastically well,
Then my $10 could become much more, maybe $15 or $20.
exactly, you have the potential for a much bigger return than you'd get from the savings account. But it's just potential.
Got it. So higher risk offers the possibility of higher returns, but it also brings a greater possibility of losing money.
And lower risk usually means less chance of losing your money, but also less potential for it to grow quickly.
So it's a trade-off then.
It really is. And people often try to sort of balance this out. They might put some money in lower risk things and some in potentially higher risk things, trying to find a middle ground,
Right, spreading it out a bit. Now, are there common mistakes people make when thinking about this?
Oh, definitely. One big one is thinking that high risk guarantees high returns.
Like go big or go home always works.
Kind of, yeah. But it doesn't work like that. High risk just means a higher potential for returns. It equally means a higher potential for bigger losses.
Yeah.
You have to see both sides.
That's really important. Potential, not a promise.
Exactly. And another thing, sometimes people forget, there's actually a risk in being too safe.
How so? Being safe sounds good.
Well, yes, but think about things getting more expensive over time. Groceries, rent, inflation.
Right, stuff costs more next year than this year.
If your money is in something super safe, but it's barely growing, maybe it isn't even keeping up with those rising prices.
So even though the number of dollars might not go down, what you can buy with it does.
Precisely. You might not reach your money goals if your money isn't growing enough over the long run. That's a risk too.
Okay, that makes sense. So if someone is listening and thinking about this, what's a simple first step?
I think the first step is really just thinking about yourself. How comfortable are you with this idea of uncertainty? How okay would you feel if the money you put somewhere went down sometimes, before maybe going up?
Like choosing a ride at a fun fair. Some people like the gentle ones, others want the faster, bumpier ones.
That's a great analogy. Yeah, which ride feels right for you? There's no single right answer.
Okay, know your comfort level. Anything else?
Also, think about why you need the money and when. Is it for something coming up soon, like maybe paying your rent next month or fixing the car?
Yeah, short-term needs.
For money you need soon, you probably want very little risk, right? You can't afford for it to disappear.
Makes sense.
But if it's for something much further away, maybe saving for retirement years down the line?
Then maybe you can handle a bit more bumpiness along the way.
Potentially, yes. Because you have more time to recover from any dips. So your timeline matters too.
Right, so it's about matching the risk level to your comfort and your goals.
You've got it.
So wrapping up then, risk and return are linked. Generally, higher potential return comes with higher risk.
And lower risk usually means lower potential return. Understanding this helps you make choices.
Choices that feel right for you and what you're trying to achieve with your money.
Absolutely. It's about being aware and making informed decisions.
Well, hopefully this chat has been helpful. If you found it useful, maybe share it with a friend who might be curious about this too.
And do subscribe if you'd like to hear more simple chats about money basics.
Thanks for tuning in.
Bye for now.